giving my videos a watch. I also do want to thank everyone out there that has provided feedback on these videos. I really do genuinely appreciate you guys taking the time to watch my videos, read my emails, give me feedback on it. I love that interaction with my broker partners, and I really have had a lot of valuable conversations and communication since I started doing these. So thank you very much. So let's talk about some recent updates or recent news that has come out in our industry. If you've been paying any attention over the past couple weeks or so, rates have been starting to get a little better, which is good for everyone involved. So let's all clap for that. Hopefully that has enticed you to start getting more production, having more conversations with borrowers, perhaps looking to actually refi, do cash outs, still purchases are out there and things like that. Let's talk about purchases. There have been a ton of articles coming out saying the listing prices nationwide have actually started to decrease, which is also good for us because what that does is that gives your buyers a little bit more buying power, right? It opens up your potential buyers in general as well, right? Lower listing prices increase borrower affordability, period. So hopefully, again, much like the interest rates improving a little bit, hopefully that is enticing a little bit more business on your end from the purchase side of things. I hope you're out there still having those very valuable conversations with your realtor partners. Share all this information with them because a lot of people out there don't really understand those different things that are going on and how they're going to affect the market. Speaking of the market, there was another announcement that came out, not necessarily an announcement, but a little bit of a news article that said the meeting minutes from the last Fed meeting leaked, I guess you could say. And there have been additional discussions that there's going to be another 75 basis point increase to the Fed funds rate in the next meeting this month, actually. Now, if you've been paying attention to the market, that has actually already started to be baked into the market. So again, we discussed this in previous videos. Doesn't have a really direct correlation on mortgage interest rates, but just keep an eye out on it. And again, I always entice you guys to get out there and read articles, watch videos, just inform yourself so you can then be a valuable partner to your clients. And then speaking of the interest rate market, I do want to discuss one important topic on this video. And it's a topic that probably, if I had to guess, a lot of salespeople out there in the industry, whether you're a real estate agent, or loan officer, or broker, you don't necessarily understand too much. And that is the idea of hedging. So every single, right, I work for a mortgage lender. Every single mortgage lender has some sort of secondary and capital markets department. And one of the most important functions of that department is making sure that the company isn't losing money on the interest rates, right? So obviously there's an interest rate market out there and companies have to make money somehow in order to keep the lights on, continue paying the salespeople, continue to paying the operations people and everything like that. So one big function on how to make sure that mortgage companies do make money or essentially don't lose money is this idea of hedging. So what is hedging? Think of hedging as like an insurance policy. So I'm going to walk through a quick example of with you to hopefully explain a little bit in more layman's terms so you can understand how hedging works from the lender's perspective. So when you have a client, right, you're a broker, let's use this example, and you have a client, and your client is interested in getting a loan, and they want to lock in a rate. Let's say they want to lock in a 5.5% interest rate. And let's say that 5.5% interest rate on the day that they lock, let's use today, is paying 103, or it's paying 300 basis points. Now that lender puts that price out there for that rate, and that price includes having to pay you and I, right, the salespeople, having to pay any type of expenses that you have originating that loan, and then any additional margin, right, any additional excess that mortgage company wants to make. So let's say 5.5 interest rate is paying 103. And let's say you lock that for 30 days. Well, guess what? 30 days from now, that price is probably going to change. It's either going to be a little bit better or a little bit worse. Let's use the example where it's a little bit better. Let's say in 30 days, the lender goes to sell that interest rate to an investor, and that investor is actually willing to pay the lender 105 or 500 basis points. Essentially, on the surface level, you're like, oh, well, look, this lender actually made 200 basis points. That's great, right? We made a lot of money on this loan. Not exactly, because what that lender did 30 days earlier when that borrower locked that rate in is they put a hedge on, right? So we talked about this idea of hedging, this insurance policy. They put a hedge on saying in 30 days, we go to our broker dealer and we say, hey, broker dealer, in 30 days, we're going to put a hedge on for 103, right? So it's a 1-to-1 ratio. So you lock it in for 103 or 300 basis points. 30 days later, 300 basis points is going to be paid out. Well, again, the pricing actually got better in 30 days. Well, you still owe that money to the broker dealer. You still owe the money to that hedge company, right? So you're actually paying that hedge company the difference of the 200 basis points. So you still make your 103. You could still pay all of your salespeople. You could still pay all of your expenses and things like that as the lender, but you have to pay that additional 200 basis points to the broker dealer. Let's say the opposite happens. Let's say in 30 days after you lock that 5.5% interest rate, pricing actually got way worse. Let's say that the investors on day 30 are only willing to pay you 101 or 100 basis points. Well, on the surface, it's like, oh, well, we lost 200 basis points as a lender. And if we continue to do that, we're going to go out of business. Well, again, keep in mind, 30 days earlier, you put a hedge on for 103 or 300 basis points. It's basically a contract saying, hey, even though that we can only sell this interest rate and sell this loan in the secondary market for 100 basis points, we locked it at 300 basis points. This broker dealer entered a contract 30 days earlier saying we will still pay you 300 basis points. So that's essentially how hedging works. And again, I'm no expert. I've tried to get a little bit more understanding of how the secondary market works because it does help in my conversations with brokers and things like that. But if you're someone out there that has no idea how the secondary market works, specifically hedging, this is basically how it is. So when you're talking to your account executive, you're talking to your real estate agents or your borrowers, and they're asking about the interest rate market and things like that, and they mention words like hedging or they mention words like that, this is basically what that means, right? It's an insurance policy on that interest rate because as a mortgage lender, much like these brokers that have these companies out there, you guys have to make money, right? So this is essentially how we limit our risk in a fluctuating interest rate market, which we are all too keen and familiar with lately. So I hope that helps. Hope that gives you a little bit of insight. If you have any additional questions on how hedging works or just anything in general, as always, my door is open. Please feel free to reach out, and I hope everyone has a great rest of your day.